Fair value gaps are a big reason I've made 7 figures from trading. Before I learned them, I was a broke and struggling trader for nearly a decade, blowing account after account because I didn't trust any trading setup. I've now been a full-time trader for the past 3 years and have withdrawn over $1 million across 200 plus payouts. And recently, I've had multiple $50,000 days using mainly fair value gaps. In this video, I'm going to show you exactly how they work and why they're one of the most powerful concepts. So grab your notebooks and let's get right into it. Okay, let's dive into one of my favorite concepts, fair value gaps. Now let's go through a simple definition of them. Essentially, they are the empty space that's created when a price makes a sudden move. So it leaves an imbalance in price. And why is this so important? Well, when we break down markets and how we find opportunity in the markets to make money, price needs to be out of balance. If the markets are in balance, essentially what you get is just a trading range. And it's not until the market moves to levels that are out of balance that we get opportunities. So when the market is trading at lows, right, it's out of balance from equilibrium. So just imagine that this is equilibrium. So we have 50% of a specific range. And then we have discount and premium. Okay, so the only way that the markets provide opportunity for us as traders to make money is when they're out of balance. And that's basically why fair value gaps are so powerful, because it's showing you an imbalance between buyers and sellers. So I know there's a lot of conflicting information out there as far as how markets operate. Is it run by an algorithm? Is it not? And my question to you is, does that really matter? Does it really matter how the markets operate on the back end? Because even if you did know, it's still not going to have an effect on the trade that you're placing right now. So the probability is all in your hands. Okay, how are you managing that specific position? And when I try to visualize the markets, and this is just how I've been able to, break things down in a digestible fashion where I can understand it and it makes sense to me, is a fair value gap really just shows me an imbalance between buyers and sellers. All right? And that's really what we need to make money. So when we talk about fair value gaps, what is a fair value gap? A fair value gap is a 3-candle pattern, right? Where you have 1 candle, 2 candles, and 3 candles. But as you guys can see, this 3rd candle does not fill in the body of this candle. Okay, so as part of that simple definition, right, it makes a sudden move, leaving an imbalance. So this is creating what? A buy-side imbalance. And the way that I view these is that buyers are in control of these markets. But that's all you need to know. I don't really care if there's an algorithm driving it or not. Pay attention to these patterns enough and watch them pan out, and they will help your trade. They will aid in your trading. They will help you determine, which direction is order flow really going. Is it going higher or is it going lower? And when these levels get inverted, right, now we have possible opportunities to go the other direction, right? Because now all of a sudden this buy side imbalance is being violated to the downside. That's really all we need to know. What side is the market imbalanced towards? Are there more buyers or are there more sellers? So when the markets get rebalanced, right, think about this. All it's really doing is offering price at these levels where we created an imbalance. So I've read numerous amounts of books and I've read a bunch of articles on this. And, from what I've gathered at least, right, this is my experience, my knowledge of the markets. These large funds and these large institutions, when they place orders, they're not being able to get filled at that same price. Let's say if they have, a very massive order. Let's say they want to buy $100 million of something, or maybe even more, maybe $250 million of something. They can't get the same fill price because these markets move without them. So if they get filled on, say, 100 million of it, and the other 150 million needs to get filled, well, what happens is when that order goes through for 100 million, it causes prices to, it causes these prices to jump. And when it retraces, now they're able to fill the second part of the order, right? Okay, this is how I, internalized it. This is basically how I visualize the markets or try and interpret the context of the markets, right? Because there's elephants in the room that are trying to buy up a specific asset, and they're not going to be able to get filled at the correct prices. So let's say that this is, you know, I don't know, $1. So this price right here is $1, okay? So they get filled on their dollar, but now all of a sudden it jumps to here. So instead of it being $1, now it's $1.25. But they still want to get the rest of their order filled at $1. But when it returns to $1, now they can fill the other 100 million or the other 150 million, okay? And vice versa, right? If they're trying to sell an asset or offload an asset, you have this sell side imbalance. As the price rebalances at that level, they're allowed to sell more of it at the price that they want to sell it at, okay? This is our typical reaction that we're expecting from a fair value gap fill. Now, it's not going to be picture perfect like this every single time. Like, you're not going to get this old high, and then you're not going to get this low that pretty much lines up with that. Sometimes it's, you know, perfect. Other times it's not so perfect. And that's just part of markets. There's a little bit of randomness to this. Okay, so now that we understand what a fair value gap is, let me walk you through 3 essential tips to actually trading them profitably. But first, fair value gaps are just one of the many trading setups in my arsenal. And while they're great on their own, when I can combine it with 2 to 3 other concepts, it really takes my trading to a whole nother level. So if you want to learn all of the trade setups I use in depth with examples of entries, stop loss placements, etc., make sure you download my ultimate guide to trading executions, and I'll leave that link in the description. Okay, so essential tips. Tip number 1, when bullish, fair value gaps presented in discount are much higher probability, and vice versa. So let's go through a couple examples of what I mean. When we're looking for fair value gaps, this is really where you have to implement another concept, and it's basic trading ranges. So when we're trying to determine trading ranges, all you're trying to do is find a specific range that has a swing low and swing high, and use a Fibonacci tool. Okay, so when we're drawing that out, right, as I mentioned, we need markets to be out of balance. And when they're in balance, we're not really getting the opportunity that we want. So when we're hunting fair value gaps when we're bullish, the fair value gap that resides in discount is much more powerful than the ones that reside in premium. So as you guys can see here in this example, we had a much larger fair value gap that's resting in discount based on this specific swing. So we have the swing low, swing high. These bullish fair value gaps in here are low probability. Okay, so if we have an overall bullish bias on a specific market, the fair value gaps that rest in discount are much more important. And yeah, you could probably say, oh, well, there's a swing low here and there's a swing high here, so isn't this technically resting in a discount? Yeah, but this is not really an obvious swing point. Okay, so when I zoom out of this market, okay, what I'm looking for is, you know, visible swing points. This here is basically just a straight line higher. Okay, this is not really a pullback. This is not a pullback that's visible. Okay, so when I'm looking for swing points, I need something that's visible that, you know, if I turn my candlestick chart to a line chart, it needs to show me market structure. And if you turn this candlestick chart to a line chart, you probably wouldn't get the same detail. It'd be like this. It would look like this, and then like this. Okay, so this is not a real swing point to me, guys. When you're looking for impulse legs and swing points, it's got to be very, very obvious. So I'm looking at the most obvious swing point, the swing low and swing high. Notice how we violate these fair value gaps, and this is where traders think that fair value gaps don't work, but they're getting the context wrong. These fair value gaps are resting at such a premium that they fail because it's going to target this fair value gap. Then when prices are rebalanced, right, and it's more out of balance for sellers, right, this market down here is in a discount now. So once it's in a discount, it's offering you an opportunity to make money because this market is now out of balance based on this specific swing. Okay, it's out of balance and it's oversold, quote unquote. Now, maybe the ICT fanatics are going to come after me, but you know, it's basically just how I'm processing things. So this really was just one example, but you guys can see here that there's another example here. Okay. Now, I don't know if I don't see any bullish fair value gaps in here, but if you saw one on the lower time frame, you would just completely ignore it because this is the fair value gap that's resting in a discount that they're going to target before it goes higher. Okay, so we need markets that are out of balance, right? That's the whole point of using this. We have a buy side imbalance. It needs to get rebalanced, and that price needs to be offered again, right, based on that range to be able to go higher. It needs to be in a discount. Another example, we have a buy side, a fair value gap here, right? That fails, and then it goes to fill in what? It goes to discount here, right? This buy side imbalance is resting in a discount. Now, there's definitely risk in it possibly trading lower because there's another fair value gap all the way down here, and that's part of trading that we're just not going to understand. There's multiple fair value gaps that appear, all right? There could be multiple other concepts that you are seeing that appear, and it's just part of trading. Part of trading is finding a high probability trade. That doesn't mean a trade that's going to work out 100%. Sometimes the best A+ setups fail, okay? And if you're trying to trade from a short-term perspective, you can use these failed fair value gaps as inversion levels to just get a short, quick counter-trend trade to fill in an imbalance that you're seeing, okay? So you guys can see it came down, hit that 50% of this range, and then shot off again. Okay, so this fair value gap is resting in discount. This one is not. Now, when it comes to premium, it's the same thing. We have fair value gaps that are in discount, right? So we have 3-candle pattern. There's a gap there. This is really the high probability fair value gap. This one, not so much, right? Because it's resting in a discount based on this current swing. Swing high, swing low. A very visible swing. If I zoomed all the way out, you guys could easily see that swing point, okay? It's very visible. I'm not sure if I reviewed this same example here, but you guys can see here, we have another bearish fair value gap. I don't believe this might be 50% of this swing. I didn't measure it out. But let's say if there was a fair value gap that appeared lower down here, just for example, let's say if a bearish fair value gap appeared down here, that's not the high probability one. The high probability one is going to rest higher up in that range. Here, same thing. We have this fair value gap resting in discount. And this is why it's so interesting, and maybe the markets are run by an algorithm, or maybe they're not. Maybe it's all mathematical. These markets really are engineered. So when you're finding the proper swing points, you will find that fair value gaps appear at these premium and discount levels. Okay? Coincidence? I don't know. That's not for me to answer. I just know when it provides these opportunities, I'm going to short the market. All right? Okay, essential tip number 2. Size matters. The larger the fair value gap shows larger imbalances in price. And I usually avoid tiny and less obvious fair value gaps. Just like I mentioned with the swing points, it's got to be obvious to me. So a larger fair value gap depicts what? A larger imbalance between buyers and sellers, right? Those are your high probability setups, okay? The tiny ones and the less obvious ones, there's not that much of an imbalance between buyers and sellers, so obviously it's going to be a lower probability trade. In this example, you guys can see here, we have a very small fair value gap, and we have a large one. You guys can see that, yes, we did respect the this fair value gap based on the bodies of the candles, but how many times are you going to end up getting stopped out in here trying to go long without realizing that there's a larger fair value gap below you? All right? So, part of trading fair value gaps properly is your stop loss placement, which we'll get into in a little bit, but your stop loss placement is going to play a vital role in you being able to profit from these trades or not, and how confident you are in trusting these trades. Okay, because if you get stopped out a couple times, that third trade might pay for all the losers, right? But if you're thinking that it's going to go lower, and we haven't violated this fair value gap, well, you're not really going to be a happy camper, okay? Because you tried longing twice. The third time, it didn't work out. Or so the first 2 times didn't work out, so you decide to go short the third time, and then all of a sudden, what happens? That's when the real move happens, all right? So be less quick to change your bias based on specific price action. Here, another good example. This is just a very small fair value gap. This is obvious, okay? The fact that we haven't retested in that level, what happens? This is really where they're trying to reach to. They're trying to reach into this level to rebalance it and then trade lower. This is a large fair value gap that needs to be rebalanced at some point, okay? So it would not make sense to me if the market traded in this fair value gap and then dumped, right? Because I see this happen all the time. They're waiting to run these fair value gaps into higher levels, you know, and bigger imbalances, and then they're going to take it lower. So another example here, you have a very small fair value gap here, but really this is the better fill price. So when you're thinking about trying to go long in here, while yes, it did work, like where's your stop loss? Okay, like where's your stop loss in here? This fair value gap, you know, if you used the low of this candle, it would have been totally fine. And you're getting better risk reward out of this specific trade. Okay, so instead of buying it up here, right, maybe you're buying it down here. And just keep in mind, guys, that this is not going to be picture perfect. Like I mentioned in the examples, sometimes we get markets that trade to fair value gaps and never, you know, they never go sideways like this. And other times where it hits that fair value gap and then it just dumps straight away. All right, it's just part of the game. It's part of the uncertainty with all of this, all right? Now, finally, tip number 3, fair value gaps may require 1, 2, 3 or more attempts before the trade idea works out. So your trade idea is often not invalidated until you actually start seeing some major reasons for trades to turn around. Okay, so look at this fair value gap, for example. If you were trying to go long on this fair value gap, maybe you went long as soon as it traded down into it here. All right, maybe you took a loss. All right, when you put your stop there, you took a loss here. Maybe you went long again here, and it got a little bit of a run, but maybe you moved your stop to break even. Okay, so like, let's say if you entered here, and then it ran up here, and then all of a sudden you move your stop to break even to, well, let me go back. Let's say you entered here, right? It rallied a little bit, then you move your stop to break even. Here, you're getting stopped out at break even. So now all of a sudden you're 1-1. All right? Are you going to be able to have the confidence to take the trade again? And that's where stop loss placement is so important. And it's just part of learning how to trade properly and understanding that sometimes you have to give your trade a little bit more leeway. All right? And where is the proper stop loss placement? That's all things that for you guys to figure out. Okay, a lot of times I'll err on the side of, you know, maybe leaving you at 50% of the fair value gap. So if you left at 50% of the fair value gap, you know, it's only touching down to that level one time here. Or if you use the low of the fair value gap because it's a large fair value gap, right? Because typically when you get a very, very large fair value gap like this, you don't want to see a trade to the other end of that. Look at this one, for example. This is a very large fair value gap. If I was to short this level, I would not want to see it go all the way to the high, right? The fact that it ran to the high, that's giving me indication that maybe I'm wrong and the market is going to go the other way. And look what happens. It goes the other way. This is another great example, right? Just because this fair value gap is getting retested so many times does not make the trade invalid. It just makes you impatient. Because let's say if you're abandoning this idea, the fact that we have this very large fair value gap, this is a quite chunky fair value gap. Not only that, but the context behind it is we created a new low. So we're creating a market structure shift here. So we have a market structure shift here. This fair value gap is pretty large. All right. If you shorted the first retracement and put your stop loss, you know, all the way at the high of that fair value gap, now it becomes a test of patience. Do you have the fortitude to stick with the trade idea and let it pan out? Okay, because this is not a short period of time. We're talking about the 23rd all the way till the 29th. This is 6 days later, and then it finally starts moving. Okay, this is on a 1 hour time frame, by the way. So if you're seeing something on the 15-minute, you know, it might be a couple hours. This might be a day later. You know, are you going to abandon your trade idea because it keeps retesting your patience? Right? Do you have the patience and fortitude to stick with this trade idea long enough to see this run? Because I guarantee you, if you can time it right and scale into trades, this run here is going to more than make up for your 1, 2, 3 losses. Okay? That's proper risk management to me. When I take, you know, 1 to 2, 3 small losses on a trade idea, that third or fourth position, if I can scale in multiple entries as it starts running in my favor, now all of a sudden, it's not just a 1 to 3 risk reward anymore. You can turn those trades into home runs, guys. And this is the power of fair value gaps. When you can stick with a trade idea that makes sense, that has context behind it, you have to be able to trust these setups. And that only comes with experience. I'm just kind of walking you guys through some of the examples that I see. But these examples occur all the time. All right, same thing here. We have fair value gaps being retested, retested, retested. But, you know, do you have the fortitude to be able to catch the one that really matters? All right, yes, these ones pay off short term. So, like, yes, you can go long here and then maybe exit at the highs. But where's the home run trade? The home run trade is really here. Because if you could scale into this trade and then you get this massive run like this, and then you're exiting at the highs, right? Again, this trade makes up for all of this sideways price action. So again, recapping these guys, you know, making sure that you have fair value gaps that are presented in discount versus premium. The larger the fair value gap, the bigger imbalance there is, and I usually avoid the small ones. And fair value gaps may require 1 to 3, 1 to 3 or more attempts before the trade idea works out. So pair this concept with context, right? Do I have a draw on liquidity? Is the market in a trending environment? Are there reasons for the market to trade in the same direction that the fair value gap is being presented? This basic concept is powerful on its own, but when you combine it with the right mindset and market context, you're on your way to becoming a consistently profitable trader. If you want to learn more about the mindset it takes to become a 7-figure trader, I've put together 7 of the biggest lessons I've learned over my 14 years in the markets. You guys can check that video out right here. And as always, thanks for watching, and I'll see you guys in the next video.